Hey guys, welcome to the weekend edition. When you don't get it done on a Friday, what else do we call it? Not the Friday wrap, it's nearly the Monday wrap, but we're getting it done on Sunday night. So the weekend edition is what we've got for you today. All right, I want to go back in time today. This is, a year on from when we started doing the Friday wraps, and it started when, COVID-19 was starting to take full effect. The share markets around the world were dropping. We were getting phone call after phone call about, what should we do? And it was panic stations, right? So we created a video that we'd sent out to say, guys, as much as it sucks, markets have volatility and they go down. 1 in 5, 2 in 10, 3 in 15 years, we're going to see a fall in the market. And the one that we were having then was quite significant, and it causes people to panic. And we're trying to make people stay calm in those times. And so we created this video and we sent it out, and we got lots of positive feedback. And we thought, well, you know what? We've got this little tool that I've found that we can create these videos. Let's keep them going. And the Friday Wrap was born. But I want to go back in time and show you what's happened in that year in relation to the markets. So let me reduce me there. 1 year after the crash of 2020. All right. Between February and March, for 1 month in 2020, as Corona started to take flight, the share markets dropped significantly. Okay. In the month, the Australian share market dropped about 32% in 1 month. You might have heard the saying before, up the elevator, down the lift, in reference to the share market. And that's what happened. Just bang, down it goes. A lot of years of growth has gone in a month. As I said, we had lots of people ringing us, what do we do? And we're trying to maintain people to stay calm in this time when it's easy to panic when you're seeing the value of investments drop. And for those investors that did go to cash, that was a mistake. Okay, and let me show you why that was a mistake. Because had you have followed the herd and gone to cash at that point of time when everything was dropping, look at what you've missed out on. It's almost recouped itself back to the 16th of February highs, 7,139 points. So our philosophy is that we need you to be invested in an appropriate manner. And that depends on a lot of things, but a lot of it's got to do with the time frame that you've got. That's the majority of it, okay? If I'm 41, which I am, and I'm investing to build for retirement, which say for the argument's sake is 60, that's 19 years. I want to be invested in high growth assets. Now, our philosophy is not to chop and change, because tell me, how did I know to get out here? How did I know to get back in there? I had no idea. Do I wait till it gets up here to get back in if I got out? It's just too hard. So our philosophy is to be invested appropriately for the long term. And like I said, 1 in 5, 2 in 10, 3 in 15 years, the market is going to fall. We know that, we understand that. It's called volatility, and it works the other side as well. 4 in 5, 8 in 10, 12 in 15 years, the market is going to rise. So we're just playing the numbers, playing the averages. If we have a look at a much longer term, from 1990, had you have invested $10,000 in 1990, growth of 10,000, no acquisition costs or taxes, so it's not really realistic, but had we have invested it in an appropriate investment, Australian shares would be worth, I can't see because my face is in the way, $130,000, 10,000 invested back in 1990. US shares, $186,000. That's just almost like that set and forget strategy. Now, I'm not saying we're about set and forget. I'm saying we're about being invested appropriately, understanding the market and what it does. The financial crisis, we recouped from it. Last year, this obviously isn't, right up to date, because you can see from my slide prior that we're nearly all the way back to those highs. Okay, and if I move myself again, no, America doesn't do the same shot either. But the point of the message is, don't panic. Okay, don't get to a point where you're like, wow, it gets down here and you got to get out, because you can see it quickly jumps. Right. Be appropriately invested. Be invested for the long term. Understand how the markets work. It doesn't really feel great when it's falling, but what else can you do? If anything, you probably want to be putting more money back into the market while it's falling, while you're buying things on sale, as they say. Okay, so a little bit of a late Sunday night one. I've had a big weekend, so apologies if it's a bit of a mixed message there. but you get the gist. Right? Thankfully, I can't think of any clients of ours that did jump out of the market. I can think of a couple that are actually quite savvy and timed their way in and out and did really well for themselves over that period of time. But that's not the game we play. Our game is, let's have a look at you, let's have a look at your objectives, and then put in the strategies which suit your objectives. If you're a long-term investor, let's be invested in a growth option. Let's understand that the market does what the market does. It's going to go up more than it goes down based on this. That's just what it does. But my head's in the way. But the short-term volatility, there's not much we can do about. All right, guys, starting to rabble on. I'll leave it there. Hope to talk to you guys during the week, and I'll be on time for next Friday. All right, thank you. Bye-bye.